Well, hello everyone. This is Tom Marshall, Virginia State Retirement Planning, coming to you with an update as of Friday, April 17th, 2020. On our screen here today is a chart of the Dow Jones Industrial Average from January of 2018 through Friday. And lo and behold, during that time period, essentially 27 months, we are down in the Dow Jones Industrial Average, down 9% in 27 months. Not exactly what any of us are looking for or hoping for, but it just kind of shows you the dichotomy of what we're seeing out there right now and the fact that things are so discombobulated. We obviously are in the middle of a recession, and that's why the models started doing what they were doing. As many of you correctly pointed out, this is actually January of 18 over here. This is December of 18, January of 19. This is January, February of 2020 right here. And then we had the whole March, April, February, March, and April of just fun and excitement for all of us here. And what many of you correctly noticed was that the models, for the most part, did what they were supposed to. They started selling in the first and second week of February and sold for the most part all the way down. The thing that actually hurt everybody the most, at least to those of us who are in the stock market and doing different things, wasn't the stock market per se, it was actually the bond market. For the first time since 2008, the bond market essentially locked up. Bond market did not have these problems in 2018 when we had our correction here or January here. But for the first time since 2008, the bond market locked up during March of this year. And that's always a very bad sign because the bond market is bigger than the stock market. And if people can't get good pricing on their bonds, it grinds everything to a halt. And that's why the Federal Reserve did what they did recently, and nobody could see that one coming at all. But that's why many of you noticed correctly that the bond funds that we were using, we had to sell them. We're going to go through that here in a little bit as well. But they were behaving just like stock funds because everybody was selling bonds. And it was it's something that I haven't seen in over 10 years where the bond market is just that scared. Now it looks like they're hopefully better now with the Federal Reserve doing what they're doing, but at the time we just had nobody had any idea what the Federal Reserve was going to do, or even that they were going to step in. So this is actually the chart of the Dow Jones Industrial Average. But again, just to get us an idea of what's been going on here, in 1999, it took 2 years to achieve a 49% decline and 7 years to break even. In 2007, it took 2 years to achieve a 57% decline and 6 years to get back to break even. In 2020, it took 31 days to achieve a 32% decline. Fastest decline on record, going back to the 1920s. And we still don't know how long it's going to take to get back to break even. The reason why I bring this up is that just the velocity of this happening now is quite, we'll call it scary, but it is a concern for all of us because these things can change in a heartbeat on a dime, and a lot of this is being driven by large institutions that have these things going on. One of the reasons why we're doing this video and the different questions we're getting is, well, why aren't we fully invested yet? The market has come back. We made these lows here in March of this year. Now here we are back to here. How come we're not fully invested yet? And the way the models work, we all know right now that we're in the middle of a recession. What we don't know is how long this recession is going to be. Is it officially done for the most part when we all get back to work, or is there more blood that needs to be spilled, so to speak, when it comes to the economics? So what's interesting though is that this is a chart from 1999 through last week,
And what you'll notice here is that on this chart, this is the S&P 500 index. So this is 99 to 2000, 2000 to 2003 down here, 2003 to 2007, 2007 to 2009, and then here we are after the races, and then here we are today. What you'll notice, and what is somewhat interesting, or at least somewhat intriguing, is that, every time we've had a recessionary decline, the decline has tended to stop, at least partly, in March of that year. So in 2000, had a decline. The decline stopped the third week of March of 2001 and made back half of the decline. So in this case, there was about a 30% decline in 2000, 2001, and then the market came back and earned back about half the decline before it started to roll back over again and hit new lows. This was a 50% retracement level. Same thing happened here from 2002 through 2007. Up and away. And then 2007, we had our first inkling of the great financial crisis. Dropped about 22, 23% first. And then we made back half of it. And we hit that bottom in the third week of March of 2008. Made that half, and then we rolled right back over and made new lows. Now we took off to the races again. Here we are. This is the highs of February, March of this year. Had our correction, and wouldn't you know it, the bottom happened during the third week of March of this year. And here we are back to about half of what we lost on the way down. So the key thing is, to make sure that this thing doesn't roll any more downhill, is that we have to make back more than half of what we lost. So these last times, we had a significant retracement, came back, and then it stopped in 2000, 2007, same thing, 2007, 2008, and then here we are. So we're kind of at this inflection point where we have to keep going from here. If we don't, we're at the mercy of this thing keeps rolling back over, just like it did in 2000 and in 2008, as far as these retracements. So the main thing I wanted to show you with this chart, though, is that during a major recessionary decline, it's very common for the stock market to claw back about half the decline before it starts to roll back over again. Now, hopefully that doesn't happen. Hopefully the actions of the Federal Reserve have fixed that. But right now, the way the models work, we just don't know yet. So we can't take the risk that we go even further down from here. And so that's why you're seeing partial investments in the models and not full investment in the different pieces. This is another chart showing the same thing. This is from 1997 through a week or so ago. And what you'll notice here is that as soon as we break down this middle line, this is the moving average that stays in the middle of the Bollinger Bands. As soon as we break below it, we tend to stay below it. So this is actually 2001. We come back and touch it. We break down below. We come back and touch it and go back down again. We stay down below it until we break back up. Same thing happened here in 2008 as well. Broke down below it, came back up and touched it, and then just went for another fun ride all the way down again. Now, the good thing is I think the Federal Reserve has got a handle on what's going on. They have signaled every intention to do what they need to in order to keep this stuff moving. But here we are again. This is right now, this is April of, last Friday. Here we are right at this midpoint again that we touched right here and right here. So we touched this same midpoint. We dropped below it in 2000, came back up and touched it, dropped below it in 2008, came back up and touched it. We dropped below it in 2020, came back up and touched it. What we have to see right now is we have to get back above this line, which is about 2894 on the S&P 500. We got to get above it. We've got to close above it, and we've got to stay above it in order to make sure that we have a chance to keep going higher from here. because historically this is where these rallies stall, and they tend to roll right back down from here, just as they did in 2000 and in 2008. Normally, I wouldn't be too worried about it, except we have to be very clear. This is probably the worst recession any of us will see in our lifetimes. When you force stop an economy like this, many of you know we have business clients who are restaurateurs and retailers. Half of them, I don't know if they're going to make it out, just because of the lack of traction and income. It's brutal. I'm not sure it's going to happen this way. So hopefully they'll be okay. But the larger issue is that once you're below it, this line, you got to get back above it in order to make sure that you can keep going from here. We're not there yet. The other issue we have right now is price. There's many ways to measure price, but one of our favorite ways to measure price is the Warren Buffett way. Warren Buffett has always talked about market cap to GDP, and many of you have heard us talk about this as well. So market cap to GDP is you take all the stock that you can buy right now, which is the Wilshire 5000, and then you divide it by the gross domestic product of our country, and it tells you how much of our GDP of our country does it cost to buy the stock market. So to give you an example, this is a chart from 1970 through a week or so ago. Actually, that's a Friday. In 2000, at the height of the dot-com craziness, it cost 132% of GDP to buy the stock market. So talking 132% of the GDP to buy the stock market. Okay. Then we had our correction, and then when the recession was over, it cost 75% of GDP to buy the entire stock market. Then we had 2008, we came up here and we had our further correction. And then at the pit of despair, it cost 50% of GDP to buy the entire U.S. stock market. So normally when you have a correction, this accounting value has, when the recession ends, tends to be a lot lower than where it begins. So you would normally expect it to be at least 100% of GDP to buy the stock market, or lower, even we're in a recession, not a correction. In January of this year, January, February, it costs 150% of GDP, gross domestic product of our country, of our economy, to buy the stock market. So it costs 150% of GDP to buy the stock market. We had a correction, we came down to 125%. But as of Friday, it costs 132% of market cap, 132% of our GDP to buy the stock market. So the reason we're also a tad bit concerned is that this is not where these things typically end. Recessions typically end where it costs 100% of GDP. GDP costs 100% to buy 100% of GDP buy the stock market, or 75%, not almost where we were back in January, February. Again, so this is just not where these declines typically end. And again, I realize there are some interventions by the Federal Reserve, which is wonderful. I'm glad they did it. They needed to do it to stopgap this stuff. But typically, when you have a recessionary decline in the stock market, a recessionary decline in the stock market does not stop or does not renew itself when it costs 132% of GDP to buy the stock market. Usually it's much cheaper. And so that's a concern right now. Also, another way to look at valuation is called the rule of 20. And again, you can't make any long-term projections off of this, but it just kind of helps show you where we are historically. But this is actually an indicator created by the well-known Ed Yardeni. He has worked for several different groups over the years, but he's widely written, widely quoted, very well respected. And what he was talking about is that how do you know a stock market is overvalued? And his piece was that you take the PE, the forward price to earnings ratio of the stock market, and then you add the inflation expectation. And if it's over 20, it's considered significantly overvalued. So as of Friday, the forward price to earnings ratio that the analysts are putting on the companies, given where we are and how they think we're going to be as far as earnings going for the next year or so, has a PE, a price to earnings ratio of 19, which is nosebleed territory. And it means that people think this recession is going to be a very short-lived thing, which again, I hope they're accurate and true. I'm not so sure personally. There's too many people unemployed right now. But when you add the forward PE plus the expected inflation, we're at 20.4. We were at 21 in January, February. And the only other times we've been in above 20 in this cycle coincided with corrections in January of 2018 and also October of 2018. Those are the high water marks. So again, it's just something to be watchful of, is that if this recession that we're going to have doesn't correct itself quickly, this is telling us that we're significantly overpaying for stocks right now and their earnings base. Significantly overpaying. Another anomaly or a piece that we're looking at right now is the narrow leadership of this rally back from the lows of March. This is a chart from 1990 through this past week, and what it shows us is what the top 5 companies of the S&P 500. What percentage of the market cap are they of the S&P 500? And so when you see a low number, it means that the top 5 companies, it's a very even distribution. It means that money's flowing into a lot of different companies. Right now, though, we have this peak, and again, it can still go higher, but we have this peak where Microsoft, Apple, Amazon, Alphabet, and Facebook, these 5 companies, account for over 21% of the market capitalization of the S&P 500. Historically, when you come out of a recession, the smaller cap companies lead you out. And so here we are in 2008. The market leads us out, and you see this peak is down here, which means that it's the top 5 companies are a lower percentage of the overall total. The only time we had ever had anything similar was in 2000, when Microsoft, GE, Cisco, Intel, and Walmart made up 18% of the S&P 500 before we had our correction. And so the key thing here is, I guess what I'm trying to allude to, is that essentially this rally from the lows that we have seen is primarily a function of the largest companies participating and the smallest companies are not. And so it's a very dangerous place to be. It means it's a very narrow rally back up, but it also means this is not where you typically see the stock market begin a new wave up. It actually typically is where you see it start to peak out, because it means it's very narrow leadership, and under the hood, the smaller companies are not participating. So this is very worrisome from our perspective again, and what some of the models are going to pick up as well. Also, as we alluded to in the very beginning, what many of you noticed is that we made some changes to the bond funds. Back in the middle of March, we noticed and were watching that the bond market was having some issues. And on March 18th of 2020, the bond fund, there's a bond index fund called LQD, is the ticker symbol, liquid. And it's one of the biggest index bond funds out there. It only holds investment-grade bonds. But in one day, that bond fund had $35.6 billion of redemptions, larger than anything they had seen historically in that fund going back significantly. So we saw this at the end of the day on March 18th. And we saw that this redemptions were happening, and so we called our bond fund managers and asked to speak to our portfolio managers that we've all been using for years and years. These bond fund managers, the top 2 bond funds essentially in America over the last 5 or 10 years. And we didn't get to speak to the Alpha-centric bond fund manager until after the close on March 19th. But for the first time, it wasn't what they were saying, was how they said it. these are bond fund managers who have been were at Lehman Brothers in 2008. They've seen some bad stuff happen, but for the first time, it's almost like you heard fear in their voice. So we made the decision on the evening of March 19th just to sell all the bond funds and move them to cash and money market, because we just weren't liking what we were seeing. We knew there was stress in the bond market, even though the Federal Reserve had said they were going to backstop. Luckily we did, because the bond funds dropped even more after we sold it. I wish we could have gotten a hold of the bond managers during the day of the 19th. We would actually have sold them that day. It would have been better for us. But the main thing is that another reason why we're a little bit concerned right now, more than we normally would for just a regular correction, is that for the first time since 2008, in March of this year, the bond market essentially locked up. And when the bond market locks up, you have a significant problem, because the bond market is larger than the stock market. And when the bond market can't facilitate their trades and get liquid, that carries over in the bond market or the stock market. And that's why we saw the declines that we did. But that's the reason why we sold the bond funds, because we just didn't have confidence at that time that the Federal Reserve was going to step in. We didn't even know they were going to step in the way they did. And in 2008, once the bond market locked up, that's when the stock market lost another 25 or 30% beyond that, because bond market locks up, stock market not too far behind, and people just start selling everything because they want to get liquid. And so in this case, we made that decision. Luckily, those bond funds that we sold are still below the prices that we sold them at. But it also speaks to a very unusual time period when bonds were not doing what they were supposed to. This is, again, we didn't see this type of activity in the correction of Christmas of 2018. We didn't see this activity in the correction of January of 18. This is the first time since 2008 that we saw bond funds having as much trouble maintaining their value as the stock funds. Even the Treasury bonds were having trouble. And so, again, that's why you saw the bond fund sold, because we got concerned. And you don't know what the Federal Reserve is going to do and how they're going to react. And so we have to protect everybody's money. And that's why we put everything into the money markets at that time. Now, since that time, we've moved back into some other bond funds, but that's why you saw those bond funds move out of the accounts back in March. Here are just a list of the different bond funds that we monitor on an ongoing basis. These are all, for the most part, the five-star funds out there. But at one point in time, Alpha Citric was down 16%. The year to date, you had some other funds here. PIMCO was down 11%, and this just shouldn't be happening during a normal correction. This is actually this is when the bond market locks up. And so these are things that we look at, trying to make sure we don't lose people's principal value. We maintain spending value as well. So that's why you saw the bond funds leave out of the accounts. But that being said, it's not all doom and gloom by any stretch of imagination. This is one of the indicators that is used in the portfolios, and the idea here, this is a chart from 2006, 2005 through Friday. And the New York Stock Exchange has a bunch of different securities that trade on the New York Stock Exchange, as well as some closed-end funds. And one of the good ways you can tell if a market has bottomed for good is that once certain metrics happen, you can get a little bit more comfortable. So the idea here is there's a 200-day moving average of each individual security. And what you want to figure out is how many different companies are above their 200-day moving average, which is a way to test the waters and make sure that that means that they're kind of in an uptrend, if you will. And when you start getting more comfortable that you can get long and get more aggressive in the stock market is when after the number comes down significantly, and very few companies are above their 200-day moving average here in 2008, and then 2011, and then this is actually 2016, and then 2019. Well, here we are right now. So in 2020, we actually got down to about 4% of the companies on the New York Stock Exchange were above their 200-day moving average. Very low, very, very low. But where you start to look at is when you get back above 15%, that's when you can get a little bit more comfortable that perhaps the bottom is in and you can start adding more exposure to the stock market. We're almost there right now. In fact, if we have a good strong day tomorrow, right now we're at 14.8%. We have a nice strong day tomorrow or Monday. That would allow us to put even more money back in. But until you get above that 15% level, this level here didn't happen until January of 18 back here. This was January of 16. This was 2011, and then this was 2008. You see that sometimes they can spend a lot of time under 15. But here we are back down, back up, boop. Maybe this is it. And this would cause me to say, okay, perhaps the Federal Reserve has saved the day and things are now different and we're good to go. But if we close it back above that, that will give us another opportunity to add some more money to positions in the stock market. Here's another one. You can also measure it with the S&P 500. So this is actually the S&P 500 at the top. Here are the SPY, which is the ETF that tracks it. Below here are the moving average of the number of I'm sorry, not moving average. It's the number of stocks in the S&P 500 that are above their 200-day moving average. The one before that, we just looked at the New York Stock Exchange. This is the S&P 500, and we're very close to going back above this level for the S&P 500 as well. So again, if we can just get back above that 15%, 20% level, we can start adding more exposure, and perhaps the Federal Reserve has fixed this, and we are good to go. And if we are done, this is kind of a chart of kind of where we're at right now, but where could we be? So right now we're kind of between two options. This is the S&P 500 right here. This is from September of 19. Here we are right now. We're kind of between a rock and a hard. I would say rock and a hard place. We just need more confirmation. This is March of this year, and either we turn. We're right about here right now. And either we turn and we come back down and fill this box for a slightly lower low, or this is done now and we're off to the races. So we're just waiting for confirmation. This is a very unusual time frame, being down 32% in 30 days and then being up 15% in 15 days. This is something you don't normally see. This is a market that is having issues with positioning itself and that sort of a thing. But what it tells us, though, is that either we're off to the races here, or we're going to go maybe make new highs. I mean, the Federal Reserve is just pouring the money into the situation here, and perhaps that fixes it. And we just need more confirmation, or we might just roll over and kind of go back to lower lows or kind of just a little bit lower type of a thing. But the idea here is that we are waiting patiently for the rest of these models to kick in. If we can get at least 15% of the companies in the S&P 500, or 20% of the companies in the S&P 500, and 15% of the stocks on the New York Stock Exchange to get above their 200-day moving average, that tells us that probably more realistic than not, that the bottom is in, and we can now blast off, and hopefully everybody will come back and we'll do fine going forward. So that's a brief synopsis of what we're seeing right now and kind of what we're waiting on. We're very close to adding more money to the stock piece in the different portfolios. In the meantime, we are just waiting patiently so we maintain people's buying power and kind of go from there. If you have any other questions, please feel free to reach out to us. Let me know. And then we can do a phone call or a face-to-face. We're pretty good with the COVID-19 in the office right now. Nobody is sick. But yeah, anything you need, just let us know. But again, looks like we're very close to a turning point. Hopefully we get there. And if you have any more questions, just let us know. Again, you all have a wonderful day, and we will talk to you soon. Take care.